Welcome back. Let's get going with our next keynote. We have here with us Gaston Gelos, who has, as of September, come back to Europe, finally, after 25 years in the US, and most of them at the IMF or in some representation of the IMF. Gaston is now, has been appointed the Deputy Head of Monetary and Economic Department and the Head of Financial Stability Policy since September of this year. As mentioned, he previously had a long and outstanding career at the IMF and always between Western Hemisphere practical work and more theoretical work on financial stability and macroprudential and monetary policy. Gaston holds a master from Bonn and a PhD from Yale, and he's going to be talking about macroprudential policy, taking stock and looking forward. The floor is yours.
Thank you. Thank you very much, Beatrice. It's, of course, an honor and a pleasure to be here. What I'm planning to do is to talk a little bit about what we've learned so far about macroprudential policy, its effects, its implementation, but also take stock and ask, okay, so where do we go from here? Okay, so this, I'm going to first spend a few minutes or seconds on definitions and instruments used, and then discuss in some detail what we have learned about the effectiveness of different instruments. And in particularly, I would like to highlight new ways of assessing the impact of macroprudential policies. Then I will move on to discuss some challenges and the pending agenda in this area, and finalize very briefly with some financial stability issues in the current conjuncture. So let me just foreshadow the three key messages that I would like you to take away. Macropru works, and it is overall underutilized. Second, we have new ways of measuring the overall impact of macroprudential policies, which is difficult. And third, and I have to say this, of course, as someone who has spent his life at multilateral institutions, international cooperation to tackle pending non-bank issues is essential. All right, so what is macroprudential policy? The commonly used definition is the use of primarily prudential tools to limit systemic risk. So what is systemic risk? Well, systemic risk, the way we usually think about it, is not attached to the failure of specific institutions, banks, or other financial institutions. It's more generally a risk of the disruption to financial services that is caused by an impairment of all or parts of the financial system, and has the potential to have serious negative consequences for the real economy. So it's a broader definition rather than focusing, on the failure of a particular bank or such. The term was first used by Peter Cook in 1979, and the former the Basel Committee was used to call the Cook Committee. Key elements were laid out in a speech by Andrew Crockett in 2000, and a more elaborate conceptual framework was put forward by Claudio Borio in 2003. And in our recent stock-taking paper, we do that. We take stock and we look at what does the literature say, what does the evidence say, and where are missing gaps or gaps in this area, both in policy and in terms of research. Now, if you look at the implementation of these policies, emerging markets were early adopters, and they did that because they experienced crises over the decades and often associated with currency mismatches, And so many of the tools that they implemented were related to currency mismatches. But then after the global financial crisis, advanced economies started to adopt macroprudential policy in series. And as you all know, various capital and liquidity tools were adopted as part of the Basel III reforms, but also borrower-based tools, LTV and DSTI, have been used widely since then. In addition, measures were put in place to deal with systemically important institutions. And after years of tightening, the COVID shock was the first kind of big shock that was a test of the country's readiness to actually relax these tools. And now, more recently, rising interest rates pose a new resilience test for the financial system and poses new challenges also for macroprudential policy. So here is a chart that shows the net number of tightening measures around the world by emerging and advanced economies. The label is wrong. The blue ones are the emerging economies. The red ones are the advanced economies. So you see what I was saying earlier, the blue ones were the early adopters in the early 2000s. And then after the global financial crisis, you see the advanced economies adopting and tightening macroprudential policies, until we get to the COVID crisis around 2020, when we saw the first big relaxation. There are many tools in place. We can categorize them according to broad categories. In terms of individual tools, the survey by the IMF counts over 2,400 specific tools. So it's a broad range of very kind of institution and financial sector specific tools, and that makes it sometimes a bit difficult to kind of to aggregate them in some form and to assess empirically their impact. You can see that liquidity tools are somewhat more popular among emerging market economies. This again is related to the FX mismatches. So these are often related to a foreign currency, what else can we say here? I mean, the other differences are not so stark. The non-bank sector measures are less prevalent yet in emerging market economies. But again, there's a range a wide range of measures that have been adopted, and in both groups of economies. So, in this paper, we take stock, as I said, and we look at some meta-analysis of the empirical evidence. And overall, this is a difficult issue, right? Because the estimation of macroprudential policy effects needs to take into account the pretty obvious endogeneity problem, right? Macroprudential tightening occurs when you have credit booming, when house prices are rising, and so forth. So how do you assess cause and effect? And that's not so easy. But more recent studies do try to be very careful about that. They use microdata, or they use policy surprises, measures of macroprudential policy surprises to overcome, at least to some extent, this endogeneity problem. And they do find significant effect both on credit and to a lesser extent perhaps on asset prices. And overall, I think we can say that macroprudential policy does succeed in reducing the buildup of vulnerabilities. More specifically, if you look at household credit and house prices, the strongest evidence or the strongest effects on household credit come from borrower-based measures, loan-to-value ratios and debt service-to-income ratios, but also from loan loss provision measures and loan restrictions on banks. On house prices, the evidence is a bit weaker, but again, the effects of loan-to-value ratios and loan loss provisions is quite strong. Capital requirements, on the other hand, have a less directly measurable impact on household credit and on household prices. That doesn't mean that they are not useful, but if you focus on these two indicators, detecting their impact is a little more difficult. So this is another way of showing some of the meta analysis that was conducted. These are coefficients of different studies. It's like this is the average effects of tightening macroprudential measures on credit obtained through weighted least squares, where the weights are proportional to the precision of each result. And here the interesting thing that I would want to highlight is that the blue ones, the ones that are based on microdata, tend to be larger. The effects tend to be significantly larger than those effects when you use macrodata in yellow. Okay, so why is that? Well, on the one hand, these microdata studies, they do a better job at addressing the endogeneity problem that I was just mentioning. On the other hand, the aggregate data also show leakage effects, right? They show the kind of the overall effects on the economy. So it's a combination of the two that leads to these differences. What do we know about resilience? Well, resilience, I mean, we always say that macroprudential policy, a key goal of macroprudential policy should be to enhance resilience, right? It's not necessarily about the direct impact on prices or on credit. It's really ultimately, to a large extent, about making the financial system more resilient, okay? But that's hard to measure, and you always will tend to, very typically, you conflate the two effects, right? The leaning effect, you lean against, credit booms, you lean against, excessive house prices growth, and the buildup of resilience through, say, buffers, right? So when you measure the overall effects, you tend to mix the two. But I think we can say that there is evidence supporting the notion that macroprudential policy does indeed strengthen resilience, and meaning in the sense that it reduces the adverse effects on the adverse macroeconomic feedback effects from shocks. And for example, we have evidence that macroprudential capital measures can support credit during stress periods. We have evidence that borrower-based measures can increase borrower resilience, so meaning that households are less likely to default around shocks. We have evidence that tail risks to GDP growth can be reduced, so in the type of growth at risk frameworks. We also have evidence that emerging market economies become less sensitive to external shocks when they use macroprudential policies to strengthen their financial systems. These effects often are nonlinear in the sense, in different senses, but they appear to hold up through time. For example, one type of nonlinearity is that the release of capital buffers generates, additional headroom for banks and supports lending. That matters particularly when banks are close to their regulatory minima. We know that the tightening of borrower-based measures has diminishing marginal returns. So for example, tightening debt service to income ratios reduces the default probability, but up to a certain point when tightening them more doesn't help further. And these effects on resilience that I was alluding to tend to hold up, particularly when it comes to borrower-based tools. I will show you a bit more on evidence on that. Now, on the other hand, of course, you can tighten macro-pro and kill the economy. So you want to, ideally, you want to tackle specific vulnerabilities and do that in a way that minimizes undesirable side effects on the economy. And what's the evidence so far on that? Well, so far, the news are pretty positive. The undesirable side effects on consumption and output of a tightening of different types of macroprudential tools are relatively weak. So in that sense, we can argue that macroprudential policy can serve as a surgical tool to intervene when you see specific build-up of vulnerabilities in the economy without hampering the economy as a whole. On the other hand, we do have leakage effects. Of course, if you tighten macro-pro, say on banks, after a point, you will notice that non-banks tend to occupy the territory of banks. That's a big issue. You will also see, Stan has worked on this, substitution from abroad and spillovers to abroad. So these leakage effects are important, and they are really something that policymakers need to take into account. So the news are good, but they're not unambiguously good. I mean, in the sense that it is important when you think of tightening macroprudential policy that it can affect the lending or the activities by other players, and therefore that strengthens the need to expand the macroprudential perimeter. So what have we learned during the COVID crisis? I mentioned this was the first kind of test, the first relaxation of macroprudential policy. Well, as I was alluding to earlier, banks seem to be really reluctant to breach regulatory requirements. So even when, in the sense that even when regulators told them you can use certain buffers, certain capital buffers, encourage them to do so, they were reluctant to do so. But when say the CCYB buffers were released in the sense that the minimum were explicitly lower, that had a measurable effect on sustaining credit. And well, what does it mean? Well, you need to have that buffer in the first place. And going into the COVID crisis, not many countries, not many jurisdictions had very high buffers of the CCYB in particular. So I think that's an important lesson learned. The evidence, again, this is a difficult issue to ascertain, it's a difficult effect to measure, but the work that has been done by some of the authors that I mentioned here, but also by the Basel Committee, shows that is clearly consistent with this notion. I was mentioning earlier also that small open economies can dampen their vulnerability to external financial shocks through macroprudential policies. This is some work by colleagues at both the IMF and the BIS that shows the response of GDP to two shocks. In one case a VIX increase, in the other case a capital outflow, depending on the degree of macroprudential tightening. And the evidence suggests clearly that having a stronger macroprudential framework in place helps you withstand those shocks better. Okay, but you know, in a way, this is all like measuring parts of what you really want to get at, right? You want to get at the short-term resilience. You want to capture the side effects. You want to capture short-term effects, but also effects down the road. So it's a really complicated task to try to assess the overall impact of macroprudential policy, right? And it also requires you know being clear about what do you want to measure really, right? And so one attempt that we did is to look at the entire distribution of GDP and say, okay, let's think very broadly about macroprudential policy as, in a way, as a macroeconomic stabilization tool, right? And suppose you have here a distribution, a probability distribution of GDP growth, right? Now, say you face looser financial conditions, perhaps from abroad. If you're a small open economy, you have capital flowing in, interest rates low in the world, and that initially shifts your expected distribution of GDP growth to the right, right? So it's good in the short term, right? Now, this effect is temporary, however, and the distribution becomes flat in the sense that it has fatter tails. I'm not showing this, but particularly on the left. And so what does it mean? What can policy do to affect this, right? Because yes, it's good in the short term, but then you have the bigger tail risk down the road. How do we think about this, and what can policy do? So the idea would be that macroprudential policies can dampen some of these effects and reduce the fatter tails that otherwise would occur down, in the medium term. So what we do is we estimate the conditional GDP distributions following a loosening of financial conditions over time, okay, over various years, and using quantile regressions, right? And then we do the same with policy interventions. And we compare different policies. Here I will focus on macroprudential policy. And we look at how that path of expected distribution compares to the original path. Okay? But that's not enough, because you need to have a way of comparing them, right? How do you compare them? Well, one way is to use standard quadratic loss functions that we like in macro. There are different ways of doing that. We use standard quadratic loss functions for output and inflation, or only output, depending. We do various exercises. And again, we compute then the net present value of those losses with policy and without policy following a loosening of financial conditions. So you have this loosening. We compute a path of expected GDP distributions. We look at what happens if you tighten macropru. How does the expected path look like? How do the two compare? And compare the losses. And we do see, and this comes out really clearly, we didn't have to massage the data. It comes out quite obviously that you get a reduction in losses, basically a reduction in output variability when you tighten macroprudential policies. Here I'm showing you the difference in the loss function that we compute compared to the no policy scenario, right? So no policy is the benchmark, and how much do we reduce losses by tightening macropru? The red line shows broad-based tools, financial institutions-based tools, and the blue line shows broad-based tools, meaning including also borrower-based macroprudential tools. And over time, the losses are lower, so the output variability is lower, in other words. We also do exercises with asymmetric loss functions and with levels and so forth. But, qualitatively, the result is always there. And that's what I also meant by saying that the results sustain over time. They are not short-lived, right? They are there over time. Okay, so I've been quite gung-ho so far. What are the challenges? Well, there are many challenges. One is to calibrate these tools better, right? To really give policymakers a better guideline and as how to tighten, how much to tighten to achieve certain effect. Assessing risk is not always easy. We know about the institutional and political constraints. There's an inaction bias in Macropru. There are political sensitivities, particularly when it comes to borrower-based measures, preventing young families from buying their first home and so forth. There are cross-border issues that I was alluding to earlier, right? So the spillovers, and they are very important in this area. And then measuring macroprudential effectiveness is not easy. We don't have a Taylor rule for Macropru yet. How do we measure these things? It's not like targeting 2% inflation. It's more difficult. And again, so we have evidence of strong macroprudential policy effects. We have evidence that they can be used, at least in some cases, as surgical tools without broader unintended side effects. And this is good news because it also allows monetary policy to focus more on price stability. And it allows in emerging markets monetary policy to do the same and to reduce the need for FX intervention and capital controls, for example, which have their own governance and communication problems and so forth. So in light of these benefits, I would argue that macroprudential policy has been underutilized. And as I mentioned earlier, many countries went into COVID without countercyclical capital buffers. Some are now building them up. Borrower-based tools are not used everywhere. And the toolkit more generally is incomplete. Of course, we know that non-bank financial intermediation is a pending issue. The growth of non-bank financial intermediation, here on red you see the share of total financial assets has been growing strongly since the global financial crisis. And better regulation of the non-bank financial sector is really key. And it's key for many reasons, among others, to reduce the recurrent need for a central bank emergency assistance. And this is well recognized, but politically difficult. And I'm going to skip the insurance sector, but
yes,
let me highlight a little bit. Yeah, let me highlight once more this international dimension. A regulator of a fund industry in a small economy does not internalize and doesn't have the mandate to internalize the effects that the funds have in other countries, say in emerging markets where they can have a large footprint, or in the commercial real estate market in another country. And those spillovers are really important, and moreover, funds can move around quickly, and therefore, in this context, when we think about non-bank financial regulation, international collaboration is really key. Let me conclude with the notion that at this point, you may ask, okay, now we are in this moment where interest rates have risen a lot. What should we do now? Well, I would argue that Macropru should be kept tight for as long as possible. The evidence is that that tighter prudential standards help prevent stress after monetary tightening. And in addition, of course, we need to be implementing Basel III in full. And that gets to the next panel, right? Strengthen the bite of supervision. Thank you very much.
Thank you very much, Gaston.